Jesus Christ. These mortgage rates just keep going up and up. All right. Let me give you the hard, sad, fucked up numbers. All right. So since the last 30 days, Canadian government bond yields, and remember, these Canadian government bond yields are 100%. Oh, there's some swap rates and some other things, risk premium, but they are the key ingredient to where bank fixed rates come from. It's just that simple. They're from all big institutional lenders. This is where the rates are generated from, are these Canadian government bond yields. 1 year, 2 year, 3 year, 4 year, 5 year, 10 year, all along. Well, sweet Christ on a cracker, are these bond yields up? Increase on 2-year bond yields in 30 days, 24%. Like, that's a real thing. That's for reals, okay? 24%. 3-year popular fixed rate, 3-year bond yields, and also 24% increase. 5-year bond yields, not as bad, 17% jump in 30 days. Yeah, this is real numbers. This is serious stuff. Oh, Ron, well, what's going to happen to the rates? Well, just take those percentages I just gave you and apply them to the rates over 30 days. There's a delay, there's a lag, probably a 2-week lag, give or take. But this is where we're going to end up. Wherever rates were 6 weeks ago, 3-year fixed is going to be up 24%. Yeah, big time, big numbers. And is it going to just collapse if the war ends? Possibly, but unlikely. There will be, war ends next Thursday, there will be a fall off in these bond yields. There will be a fall off in mortgage rates, 100%, because the Canadian economy is doing awful. It's terrible. So there's a lot of reasons for the Bank of Canada to cut if it could. It can't cut with this inflation from the war in the Middle East. It can't possibly do it. But if there was no more war in the Middle East, there would be a change. But we don't know how long the war goes on. So what about variable? So with a 24% increase in the cost of a 3-year fixed rate mortgage, I mean, should we all just be thinking about variable? Okay, bit of an interesting story there. There's 2 parts. Let me tell you the first part. Variable rates are a function of the Bank of Canada. They set their overnight bank rate, which for the last months, 6 months now, 5.5 months, there has been no change. So the prime rate at a commercial bank, if you walked into TD or Scotia or BMO or any of those banks, any bank, and said, what's the prime rate? They would say it's 4.45. And that's the starting point for a variable rate mortgage. Now, with a variable rate mortgage, you receive a discount, a reduction from prime. It's prime less a number, okay? Well, here's what's interesting. So 30 days ago, lots of prime less 1%, lots of prime less 0.9%. There was even some prime at 1.2% off prime, which these are low numbers. These are like 335, 325. It's a very, very good numbers on basically those are high ratio CMHC mortgages. Well, that's all gone. That's gone. Instead of prime less 1, it's prime less 0.8. Instead of prime less 0.9, it's prime less 0.7, 0.75. Like, what happened? What's going on? Well, in the end, a bank must find a funding source for any mortgage. I mean, it's not just a bunch of money in the bank and in the basement of the bank in a big metal box, okay? There has to be a funding source behind it. And traditionally, banks use like short-term paper, whether that's 90-day. They used to call it banker's acceptance. That's gone now. But it's based on short-term funding. And guess what? 1 year bond yields are way up. You're going to start to see your GICs are going to start to go up. Not tomorrow, eventually. And that short-term paper cost, that securitization cost, is up. So when the cost goes up, the discounts come down. The discounts go up. The discounts come down. They're not as good. Let's just say this. I'm getting lost, but they're not as good. So they go from 1% off to 0.8% off. But still, the big question is, should I just take variable? Because variable is clearly a lot less than fixed. If most fixed rates, if almost all fixed rates are over 4%, and variable is 3.3, 3.35, 3.4, why wouldn't I take it? Like, that's a big difference. And some fixed rates are going to be 4.24, 4.19, like big differences, like 60, 70, 80 basis point differences between variable and fixed rates. Why not take variable? Okay. Two schools of thought on that. If the war continues, if inflation keeps roaring, will the Bank of Canada be forced to raise rates? They don't want to raise. They know that raising rates is not going to stop a war. It's not going to take the price of a barrel of oil down. It's not going to change the price of diesel at the pumps. None of those things. It knows that. But there's other things going up. There's like wages going up and there's foods increasing in cost. And what do? The Bank of Canada only has one tool. Every central bank only has one tool to fight inflation: higher interest rates, whether it's particularly sensible or not. So that is not impossible. Like, the marketplace, who does the analysis of what the Bank of Canada is going to do, is suggesting that there will be 2 rate hikes this year. If you look at the percentages, that's what it indicates. So I don't necessarily agree for this key reason. War could be over next Thursday. We do not know what thoughts flit through President Trump's mind. I mean, told the Japanese prime minister that, hey, you should have told us about Pearl Harbor. Like, that was just, yeah, I watched it. Like, my eyes popped out of my head. Like, I couldn't even fucking believe I was watching it, hearing him say it. Should have told us did you tell us about Pearl Harbor? Huh? The fuck? It's like crazy. Yeah. We don't know what's going to happen. We absolutely don't know. But that's a risk. You have to believe that if inflation takes off, even though raising rates by the Bank of Canada won't fix it per se, because there's other underlying causes, that the bank could still do it anyway. There's another school of thought, say, take variable, because if the war is over and rates start to fall, variable, we could actually end up with, because Canada's economy is so bad. It is bad. We lost 85,000 jobs. We're going to have crap GDP numbers, I'm sure. I mean, it's not looking great. That it could actually fall. The Bank of Canada could cut. I believe the Bank of Canada would cut until the war started. I was in that group, and I believe I was right, and I believe it was heading in that direction for summer cuts. Could the bank cut if the war was over? Yes. Yes, it could, because I think Canada's economy is just in that bad a shape. So how do you make that call? How do you decide between all these factors? Truth is, I don't really know. Like, this is just too much for one old fat man to figure out. Like, is the war going to end? Is the war going to continue? Is it going to get worse? Are these energy prices going to go to $200 a barrel? I mean, holy shit. I don't know any of those answers, but I've outlined what the possibilities are.